Did the Federal Reserve just unleash the market beast? And what does the latest Fed decision mean for your investments? First, let's set the stage. The Federal Reserve, or the Fed, is the central bank of the United States, and it plays a vital role in the economy of not just the USA, but the whole world. Its decision on interest rates impact everything from your mortgage rates to the returns on your savings and investments. Historically, the Fed uses rate hikes to cool down inflation and rate cuts to stimulate economic growth. Understanding this dynamic is key to making informed investment decisions. And today, I will explain to you what the latest Fed decision means for your investments and how you might want to position yourself for 2024. Hi, my name is Ognian, and on this channel I talk about investing and I help people achieve or at least get closer to financial freedom. On December 13th, in a move closely watched by markets worldwide, the Fed held the interest rate steady at 5.25% to 5.5% for the third consecutive meeting. This rate, the highest in 22 years, is a crucial indicator of the Fed's approach to managing the economy. Holding the rate steady indicates a pause in the aggressive rate hikes we've seen since the beginning of 2022, suggesting that the Fed is probably shifting gears in its approach to monetary policy. In the September projections, policymakers had forecasted one last rate increase for 2023, followed by two cuts in 2024. However, for the third straight meeting, the Fed kept the rates unchanged, indicating a potential change in the restrictive stance of the central bank. So, what's next on the Fed's agenda? The big news is the projection of 3 rate cuts in 2024. This outlook emerges from the Fed's dot plot, which is essentially a graph where each member places their prediction for the future interest rates. The December median dots signal a decline from 5.4% in 2023 to 4.6% by the end of 2024, translating to 75 basis points worth of cuts next year alone. But what does that mean? It's a clear sign that the Fed is moving towards easing monetary policy. Now, what is important to understand here? This Fed meeting does not mean that rates will be back down to zero next year or anything like that. But what has been weighing on the markets for the past almost 2 years now has been the constant threat of increasing of the interest rate. As long as they were increasing, rate-sensitive assets were going to go down and more people would move their money to money market funds. A money market fund is a type of mutual fund that invests in high-quality, short-term debt instruments, cash and cash equivalents. Though not quite as safe as cash, money market funds are considered extremely low risk on the investment spectrum. This meant that there would be outflows of money from stocks, real estate, crypto, etc. into safer investments. I put safe here in quotes because on a long enough time frame these are anything but safe, but that's a topic for another video. Also, the increase in interest rates by the Fed meant that the yield on the 10-year Treasury note would continue to rise, making borrowing costs more expensive for everyone. The 10-year Treasury is a type of government bond that matures in 10 years. It is a debt security issued by the US Treasury that pays a fixed interest rate until maturity. When you buy a 10-year Treasury, you're essentially lending money to the US government. In return, the government promises to pay you back the principal amount of your investment, plus interest at the maturity date. It is a widely used benchmark that basically affects all types of lending, from your credit card to real estate projects. And now, finally, after almost 2 years, the markets are taking a sigh of relief, knowing that even though rates are still in pretty high territory, the direction is at least almost certainly reversing. What has made the Fed make such a decision? The answer is declining inflation, which still remains above their 2% target rate, but has been recently showing significant signs of cooling. That is giving the policymakers enough cover to stop hiking rates and adopt a more of a wait-and-see approach. However, as mentioned, the overwhelming consensus is that there will be not only stabilizing of rates, but several rate cuts in 2024. Why should you care as an investor? Well, what you need to understand is that markets are forward-looking. The moment they sense a change in direction, all the market participants are starting to compete with each other to front-run the opportunity, which creates a momentum that is sometimes disconnected from the current reality. For example, the interest rate is still in pretty restrictive territory, standing at roughly 2% over the inflation rate and also way higher than what it was just 2 years ago. This is still very problematic for companies that need to soon refinance debt that they had taken out prior to 2022 at historically low rates. However, Because of the signaling of changes in the direction, the market is front-running the opportunity and is bidding up asset prices as a result, way before the actual conditions on the ground get better. This is just how markets work. But what makes markets so confident? Well, usually since the beginning of 2022, what would happen is that markets would start going up in the hope of a so-called Fed pivot, which simply means change of direction from the Federal Reserve. Then, on the next conference, Jerome Powell, the head of the central bank, would spray cold water on the market, saying they are not done hiking rates and basically telling investors more pain is ahead. However, the last month and a half there has been a big change. We experienced a significant rally in major indices like the S&P 500, the Nasdaq, the real estate indexes, and also in cryptocurrency assets, all signaling increased market optimism, something the Fed had been trying to avoid since the beginning of 2022. As a result, a lot of analysts were expecting Powell to try to put the brakes as he had done so many times. And yet, he didn't. In my opinion, this is way more meaningful than the fact that the rate stayed the same. It basically means that the Fed willingly gave green light to the markets to keep on rallying for the first time in almost 2 years. Now, what was the reason for that? Was it the fact that they are really seeing signs of cooling inflation and job market? Or is it that with the elections in 2024, certain talks have been had in certain private rooms, if you know what I mean? Obviously, I can only speculate. Either way, the results are the same. If the head of the Fed wanted to cool down the market rally that has been going on since the beginning of November, he would have done it very easily. However, he did not. As a result, in the day during and after the decision, everything from cryptocurrency to stocks exploded. In the stock market, the moves have been especially big in the most beaten down sectors in 2023, which are also extremely rate sensitive. Real estate, represented by the XLRE ETF, and the utilities, represented by the XLU ETF. This means that if the Fed continues with its easing stance in 2024, it could turn out that these sectors will be also one of the best performers for the next year. I personally have a lot of real estate investment trusts in my portfolio, and just in the beginning of December, I purchased even more. So I certainly think we could have seen the bottom already in that sector. However, I'm not a market timer, and I don't advise you to be either. I'm just observing market trends and making educated guesses on when it is a relatively, and I stress relatively, okay time to get into an asset. Speaking of that, if you would like to see which are my top 4 stocks for the current economic and geopolitical environment we are in, go to the link in the description. The report is free and will be sent directly to your email address. It will be up to date regardless of when you are watching this video because I'm constantly updating it. Now, with all of that said, what are the dangers for the potential market rally in 2024? Well, the main thing investors need to watch out for is the inflation data. If the inflation reaccelerates again, the Fed might be forced to not cut rates in 2024 or even do a small hike. From what I have listened and read, having in mind the big refinancing of government debt that is coming and also the elections in the fall of 2024, this is highly unlikely. However, it is very possible for the Federal Reserve to play tough, unlike what they did on the most recent meeting, in order to spook the market participants and increase the borrowing costs, which in turn cools inflation. I do not want to speculate on whether this will happen, as really no one knows, but this is the main thing to watch out for. If you're getting value out of this video, please click the like button and subscribe to the channel with the notification bell. That way, you won't rely on the algorithm to deliver any future videos like this to you, and you'll get them in a timely manner. Thank you so much. So, to sum up, the Fed's latest meeting can easily be called the pivot that the market has been waiting for a long time. All types of assets, especially rate-sensitive ones, exploded higher after the meeting. Jerome Powell had the opportunity to cool down the market rally that has been going on for the past month and a half, but he didn't, signaling perhaps a more sustainable path for a bull run in 2024. When you add to that the fact that the government has to refinance its debt at a very high rate and the elections in the fall of 2024, it is likely that a widespread bull run will be the case. However, if I or anyone, including the top analysts in companies like BlackRock or Goldman Sachs, try to convince you they know something for sure, then don't listen to them and run away. No one knows, and we're all playing a guessing game. My strategy for both me and my students in the dividend method program has not changed. I will continue to buy assets and companies that I think have solid fundamentals and are good long-term investments with great cash flow. The only thing that changes is that during times like this, I might decide to over-invest a bit in a certain asset class that I think will deliver good price appreciation in the near future, mainly to lock in a good current dividend yield. In my opinion, there are a lot of REITs which are in that situation right now. However, I'm still only investing in companies that I think are good long-term plays, regardless of whether the Fed cuts or not in 2024. Let me know in the comments what do you think about the latest Fed meeting and what it means for your portfolio. I personally read and reply to every comment I get, and I am thankful for your participation. And before you go, click on the video that should have appeared on your screen right now to continue with your investing education. Thank you for watching, and I'll see you there.